Right, really difficult time in the markets for many people. So let's do a quick stock market update with the best data out there from the biggest hedge funds, the banks, and obviously, most importantly, my own analysis. Start off with the S&P 500. What you can see on the screen there is continued downward pressure. It doesn't take a genius to work that out. And I don't just mean the historic trend. I mean what most likely to happen going forward. And you might get the odd day where it goes up, or the odd couple of days. What you really need to see, and if you go back to March 2020, you really need to see a whole month where it takes out the previous month's high. So it closes higher than the previous month was. And I think until we get there, not even looking at it, those are weekly bars. And if you get a whole week where it does that, that'd be a start. And it's just not following through on that, where it closes higher than the previous week. A couple of times it did it. We just kept going lower. I still got to put my money on the market moving lower. Any rallies will probably be relief rallies, or what you might call dead cat bounces. For now, there's just too much downward pressure. Okay, so next up, what's working? Well, we know value's working. Now that's tactical. Okay, what I mean by that is, in any decent strategy of investing, you should be looking at ticking both the value box, which is share price relative to, say, profits or assets, or share price relative to cash flow, could be another way, or discount cash flow measurement. You should be ticking that box as well as the growth box: revenue growth, profit growth, cash flow growth, and so on. Tactically, there is more weight given to value at the moment than there is to growth, and you can see it over there. And this particularly happens in higher inflation periods. Value stocks have not fallen as far as the growth ones. Anybody holding tech will know that. Put another way, the tech sector is part of growth investing traditionally, tends to have lower cash flows, low, if any, profitability, and just high profitability potential. So that's a lot of tech companies, not all of them, but a lot of them. Whereas value investing tends to have stronger cash flows, steady income, and tends to be priced below intrinsic value. Now, I want to tick boxes of value always, and I also want not just high earnings growth potential, but I actually want high earnings growth, high cash flow growth, high sales growth. So that's where I'm straddling both. At the moment, tactically putting far more emphasis on companies which are in healthcare and energy, in those meeting my criteria, than I would say tech companies, because what's happening is even the good ones which tick the value and growth boxes are being smacked down just because they're in the wrong sector. And whilst I don't do sector investing, I do bottom up. Better stay clear of some of them for now. To give examples, if you look at Apple, nothing wrong with it, ticks the value box, ticks the growth box, but you could argue there's been profit taking. I'm looking at the momentum, which means I'm really looking at this part of it. Let me see if I can give you a bit of a laser pointer on that. I'm really looking at this indicator here on the weekly bars. Each one of those price bars represents a week, and it still shows strong downward momentum. And it also does, more importantly, on the monthly charts, which is what feeds into the weekly. So it's going to continue, I think, lower for now. Like I said, you might get the odd day or week where it goes up, but the pressure downward remains. Therefore, new cash I'm not deploying in buying Apple or Microsoft yet, but there might be a time. Microsoft, similar kind of story. The reason I mentioned Microsoft, it's probably one of the safest lower volatility stocks I can think of. This is the return histogram for Microsoft. The main problem is most people don't realize that within 20 days you can be down 29% on this. So if you're leveraged, if you're using CFDs or spread bets, and you've even got just 2-to-1 leverage, and most people won't, they'll have 5-to-1, it wipes out their capital. So if they put £1,000 in and the stock drops 29%, they're down 29% if they just own the cash version of the stock. But if they're leveraged 2-to-1, they'd be down 60% roughly. And if they're leveraged 3-to-1, they'd be down about 90%. In other words, that whole £1,000 is pretty much gone, okay, by just a 29% move down. They've lost 100% because they were leveraged 3-to-1. And they don't realize how quickly that can happen. Most people say, oh, no, but over a 250-day period, it's almost always up. Yeah, you can't ride that journey over 20 days. So don't talk to me about 250 days. And it's why 70% of people who use leveraged products like CFDs and spread bets end up losing money. They just don't understand that simple data point. Looking at Amazon, that again, lower for now. I mean, we're only got back to 2020 levels, but still, if you had those wonderful gains and you started spending them on holidays, you're now regretting it. What does that mean? Do I not like Amazon? I do like Amazon. It's one of my core quality holdings, but did I sell a load of it? Yeah, I had to, because I thought to myself, you know what? I can either buy and keep hold of it forever, which I do, so I've got a little bit, or I can look at this each week and tell myself, well, I know which direction it's likely to go in, so let's just get out of the way for a while. That doesn't normally happen. This is an unusual fall. It didn't happen 6 months ago, 12 months ago, 24 months ago, 36 months ago, where I'd look to sell it even though I like it because I expected short-term falls. So this is different to that. Whoops. Let's get rid of that. This is different to that in that this is a different scale of fall, and that's why I'm out of it. Same with Meta for now. I will probably get back in at a suitable time in the future, but the nature of these falls have been more substantial, more clear. If you've been following my weekly broadcasts on Telegram, you'll see that where I analyze these stocks and the markets for the last 6 months, if not longer. I've been saying that the pressure seems downward. The extent of falls I didn't see. I didn't think it'd be this quick, this far. Costco, another one that, as you know, I like. Now, some of you will look at this and say, wait a minute, isn't that a double top? And therefore it can fall as much as that peak, which is 600 down to 500. So another 100 below that neckline would take it to 400. Yeah, probably right. I'd probably say that's a safe bet. It's going to go back to about those levels that I'm drawing there. Probably a good bet, given that the momentum's downwards, given that it's making lower highs on the momentum indicator, the MACD, and higher highs on the price. That'd be gobbledygook to a lot of people, but I think that's a good bet. A company that I like, fundamentally, but in the short term, I think, well, happy to get out of it. And it's people who are thinking like me, which is, you know what, I just want to step out of this fight. They're the ones who are bringing the market lower because we're sending sell orders all the time. Now, PayPal, fundamentally sound, again, similar kind of story. Didn't think it'd go this low by any means. Statistically, it's an outlier. This kind of a downward move for a company like PayPal doesn't tend to do it. It's a fat tail. It's an extreme move. Does it mean I get in right now? No, I'm not sure if we've got the bottom yet. I think I'll wait a bit, thank you very much, and I'll rejudge this next Friday. I'm in no rush. Why should I be? We haven't finished yet. We've got a whole load more data to share with you. Look at the campaign to teach 1 million people how to invest. That's my campaign, campaignfor1million.com. Also, have a look at the links on alpeshpatelventures.com/links. You'll see I've launched a share picking game where we're giving away £150,000 in prizes for people who pick good stocks and win each week. So, you know, you've got a good opportunity there of, in a safe environment, making money. So let me give you some more eye-catching market insights for the week and what caught my attention. Well, first of all, bear markets are quicker than bull markets. Now, that data is a little bit hard to read, so let me just tell you. It goes all the way back to 1929, and it tells you from peak all the way down to trough how much the market fell, what the percentage decline was, and by when it recovered. Markets fall more and faster than they rise. You know this. It's harder to make money and build an economy than it is to completely destroy it and sell equities. To some extent, that's another way of saying, well, hopefully these falls won't last too long. But for now, we're definitely on the downward path. And people are finding it hard to get used to that, especially big fund managers. They still want to try and talk up the market because they're long only. Nimble private investors like you and I can say, well, we're dumping a whole load of stocks and we'll just wait things out. Sadly, things are still expensive in the markets. If you look at Robert Shiller's famous CAPE ratio, price to earnings ratio since 1881, you can see, well, we're still at a pretty expensive edge. Now, if we look forward, what kind of recovery might I see? Well, I think it's either going to be a slow recovery, which is this bit up here, or it's going to be a mixed recovery. If it's a slow recovery, I think there's a 35% probability of it being slow as opposed to medium or fast recovery, then of course I want to be selective and cautious. It doesn't take a brain surgeon to tell you that. And the next steps would be I'd be holding more cash. I'd be extremely picky with any stocks, and I might look at one or two special situations where something is absolutely destroyed, like a PayPal, and might make a slow recovery. Not getting into more PayPal at the moment by any means, so just still waiting. Okay, 2022, as you already know, one of the worst starts to a year ever for the S&P 500. That goes all the way down to 1928. And you can see in red, there's very few down years, which is one of the reasons why people say buy an index for the long term, because historically, if you bought an index, you'd have more up years than down years. You'd be up, you'd make money. So what does it mean for us? Well, it means that if this happens, it's a rare event, and hopefully next year, and very often you do have a positive year after a negative, but you might notice quite a few times you don't. So if this year does end up being negative, there's a strong possibility, I'm afraid, that even next year could be. But let's not get too ahead of ourselves. We don't want to panic ourselves yet. As I said, the Shiller cyclically adjusted S&P price to earnings ratio relatively high, 37.5. So you can still see why there's a long way to go. Now, I posted this on my Telegram. It's a flow chart. I'll talk you through it. What should I do with my portfolio? The decision making starts here. Now, if it's a fundamentally sound company like a Microsoft, then you've got to ask yourself, yes, it is fundamentally sound. Then you ask yourself, am I risk averse? If you're risk averse, even though it's a Microsoft, and I told you because of these weekly broadcasts, it's still likely to go down rather than up, then you might turn around and say, you know what, I want to sell 10 to 100% of it. I don't want to get out of it entirely because I'm risk averse. If you're not risk averse, then you ask yourself, okay, it's not a fundamentally sound company, so it must be one of my performance picks. And have I held it for 12 months? If you held it for 12 months, you sell, because that's my rules. You 12 months and then you review. If you've not held it for 12 months, then you ask, has it dropped 25% from the highest it's been since I bought it? And if it has, you sell, because that's one of my rules. If it drops 25% from the highest it's been since you bought it, you get out. If you say, no, it's not that either, then you say, well, it's a performance company. I've held it for less than 12 months, hasn't dropped 25%. Am I risk averse? If you are, then you sell 10 to 100% of it. If you're not, then you just wait until 12 months are up, or it drops more than 25% from the peak. You can find that from the links in my bio around this video, or on alpeshpatelventures.com/links as well. Have a look at campaignforamillion.com too. Hope you enjoyed this. Hope it was useful and invaluable to you. Thank you very much.